and Happy New Year to everyone. My thanks firstly to the organizers for asking me to make this presentation. It's a matter that I'm very passionate about, but one that is really important to our communities, and one that I believe that we as an industry have a large contribution to make towards. But I do believe that before we can make a meaningful contribution, that there needs to be reform of the underlying state system to primarily improve outcomes for the community and to increase awareness of the state promise in this sphere. This will enable yourselves and your clients to plan for any future care costs. Current outcomes are really not acceptable. Demographic trends are actually going to worsen that situation, and those are two of the topics that I'm actually going to touch on. Then I'm going to look at some global examples of other countries that have got state systems, but a great private market as well. And then look at housing equity or property equity and some ideas that are starting to emerge across the world to help fund future care costs. So looking very quickly at current outcomes, the state system is really complicated. Some benefits are means tested, some benefits are universal, some benefits you get from the DWP, some you get from the NHS, some you get from your local authority. It's not universal across the UK, so each of the 4 nations have got their own system. A few positive points are that there are benefits that are universal, that everybody is entitled to. For example, the attendance allowance, the NHS continuing healthcare, and your state pension. However, this jumble makes it really difficult for families in crisis to actually understand what their benefits and their entitlements are. And the DWP produced a paper in 2018 that said that 40% of the people that were entitled to pension credits didn't claim it, and that 16% of pensioners that were entitled to housing benefits didn't claim it. On the other side, though, local authorities, who are really the commissioners of care, aren't receiving enough money from government, so that's reducing in real terms. The natural reaction of the local authorities to up the threshold for where they start providing care, which means fewer people get care, but when they get it, it's more complex care that they need. However, the local authority isn't increasing the amount of money that they are paying to the providers of care, who now have got more people coming in, but actually with more complex needs. They can't pay their workforce. The workforce is really lowly paid, and there's high turnover, around 30% per annum. And so we have this virtuous circle, and care homes and care providers, then their antidote is to actually take in more self-funders that can pay more than the local authority rate, but that isn't really sustainable in the future. And so, as you can see, the situation right now is untenable, but what it means is that there's a huge informal or unpaid care market that has emerged. I mean, Age UK in 2019 produced a study that said that 38% of older people receive help they need from family and friends, but equally that there are 1.4 million people that do not have access to the care and support that they need despite all of this. Now, this slide, unfortunately, hasn't been updated by Carers UK since 2017. It's a remarkably powerful slide. The 6.5 million headline number was 9 million before COVID struck in March of last year. An additional 4.5 million people have started caring for friends and family during this pandemic. So the situation is really untenable. And actually, demographic trends, which is the next topic of my talk, actually are against us, that actually the situation is going to be worse. But actually, it isn't something that only we are dealing with here in the UK. It is across the globe. So, hoping to sort of demonstrate aging population statistics. This is a typical age pyramid, population pyramid. On the left, you see the number of males. On the right, you see the number of females. The colored in section is actually the 2010 position, and the outline is what it might look like in 2035. But certainly what you'll see is a much fatter top of pyramid, The rule of thumb is that the number of people over 65 will increase by 50%. The number of people over age 85 will double, and the number of people over age 95 will treble. And so not only from a costing perspective, as we'll see a little bit later, but actually from an infrastructure perspective, the infrastructure needs to stay up to date with this. And yet what we're seeing is the number of care home beds actually reducing already because of the financial woes of the care companies that I described earlier. This situation is not unique to the UK. This is Germany 1910 to 1950 projected. So top left is an increasing population pyramid, very fat at the bottom as it increases. However, if we look at the two bottom graphs, and actually the last one more importantly, you can see the outline of the left-hand graph at the bottom on the right hand. And you can see that the pyramid A starts getting fatter at the top, similar to what we saw in the UK, but the pyramid is inverting. We're now starting to see a contracting population in Germany. France still growing. You can see across the piece, but again, much fatter at the top of the pyramid. And Singapore, again, also growing, but trending to this inverted pyramid that we saw in Germany. So we see that the population is increasing, is aging. Latest statistics show that the rate of aging is actually slowing down a little bit, but the principle is still the same. So in what sort of health will people be? Actually, this graph shows life expectancy. So the pale colors was the life expectancy in 1990. And the whole line, so the pale and the filled in colors, is life expectancy in 2013. Basically what you see is for every dark blue little block, so that's the increase in healthy life expectancy between 1990 and 2013, you have a much bigger increase in unhealthy life expectancy, which is the darker blob on the end of each of the graphs. So basically, healthy life expectancy is lagging or not increasing as rapidly as life expectancy. This means that people, as they age, will have more complex health conditions, comorbidities, chronic illnesses, and dementia in particular. So if we look at dementia, again, this is a global perspective. It's actually, interestingly, more of an issue in developing countries, where right now about 60% of the people with dementia are actually in those countries, and that's likely to increase over time. The statistics say that one person develops dementia every 3 seconds, that there's around 50 million people with dementia in the world, and that number is actually going to double every 20 years. In the UK, similarly, you can see we are sort of following in line. Right now, we're probably just shy of 1 million people with dementia, but actually by 2050, we're going to be over 2 million people. So aging populations in worse health with more complex conditions requiring more intense care. So how will we pay for all of this? And one of the statistics that people look at is something called the old age dependency ratio. How many people are there in the retired population relative to the working age population? You can see this graph in the UK. So the UK was reasonably stable, about 300 retired people for every 1,000 people in the workforce till about 2010. And then that would have trended up. So that there would have been about 500 people retired relative to every 1,000 people of working age. That's 1 for every 2. However, there are 2 things that governments can do to actually manage this old age dependency ratio, not only specifically for funding social care costs, but more for taxation in general. The one is immigration, so to bring in a lot of younger working age people, and the second actually is to increase the state pension age that manages both sides of the equation. And yet, despite these efforts, you can see that by 2030 we'll be sort of trending to 1 in 2.5 people within the working age population for every 1 pensioner. Now, what that means is that actually over time, your tax take is going to have to increase in order to pay for this emerging costs of retirement, let's call it that. And from an intergenerational fairness perspective, there's questions around whether we should tax the young for the woes of the old who've actually benefited from the system over so many years. We know from the statistics that I've shown before that actually many people are going to become informal carers, so less people in the workforce. So not an easy conundrum to solve. And it actually isn't unique to the UK. This graph just shows international examples. The green bars are the projections to 2050, and you can see that's sort of trending to 1 in 2. In the EU, the expectation basically is the ratio was about 1 in 4 at 2010, but that by 2050 or 2060 is going to be 1 in 2. Similar issues. Let's now look at long-term care around the world. I've sort of painted the picture of demographics and what have you, and I'll show you some examples of social care systems and the private markets. When I think about the private products, they're fundamentally regular premium products, I guess, paying for the failure of 2 to 3 activities of daily living until the person dies. First country to look at is France. They started in 1997. They were just initially paying for really extreme care needs, a GIR 1 to 3 there, and it was a means-tested system. It was something for people on low incomes. They amended it in 2002. They broadened the care categories, but they actually made part of the benefits universal, and it's actually funded for by contributions from the state, local authorities, public pensions, and an earmark tax, which I think helps to create awareness. The private market continues to flourish. At 2017, which is the latest numbers we managed to collect, about 10 to 11% of the population were covered, so 7.1 million people, a diverse range of products, so group and individual products, but reasonable numbers there. On to Germany next. Their state system started slightly before France in 1995, but a very well-established social security system. It's a pay-as-you-go system. It's paid for by taxes, shared equally by employers and their employees. The German system, the public system, is a compulsory system, right? You cannot opt out of having long-term care insurance as a core. You can see that the amendments that they've made have been to this tax that I was talking about. So the 1% was shared equally by employers and employees, and it's the latest iteration is now 3%, reflecting the aging of the population. They've even set aside a fund now to actually fund the care costs of the baby boomers when they need care in time. Their private market, again, latest figures were 2016, but about 4 million policies across the German population, so 4 to 5% of the population covered, growing reasonably strongly, more than 20% per annum, but interestingly starting to see iterations of products in the market. So not only the regular premium ones, but riders on disability products, riders on pensions annuities. So interesting innovation. I mean, comparable numbers for the UK would only have been about 0.5% of the population for the long-term care policies that we sold. The next item I wanted to look at actually, and this isn't a unique question that's actually been posed here in the UK because of the property wealth of the retired populations, but actually in other countries. And we've seen some innovation with regards to long-term care. So in Germany, one of the companies have a staying at home benefit. Instead of the 2 or 3 ADL failures, they actually have split the ADLs into 10, and each incremental failure means you get an incremental 10% on your benefit, but actually you can be cared for in your home, which I think is what every person wants, which is what the government believes is necessary as well to basically manage our infrastructure gap, and also to reduce costs. And the premium, again, only paid when the house is sold after the policyholder has died or moved into care. Equity release in Netherlands, probably quite standard, as you can imagine. An amount of money is released by equity release. Part of the lump sum actually paid to the insurer for a long-term care policy. And in Belgium, a little wrinkle on that actually the lump sum actually buys a guaranteed interest bond. The interest on the bond pays the regular premium for the long-term care policy to the insurer. When a claim occurs, you first deplete the capital, and once the capital has gone to zero, you then call on the long-term care insurance. So you create a little bit of a deferment and basically reduce the cost for the long-term care policy, and sort of also creates a bit of an artificial cap on the out-of-pocket cost for the policyholder. So some ideas and concepts that maybe we could bring to this market in time. So in conclusion, the current state of affairs is suboptimal. There's many people whose needs are not fulfilled. The situation is likely to deteriorate over time. We as an industry have the tools to help people. We have pensions, we have savings, we have annuities, we have insurance, we have housing equity solutions. But I first believe that the government needs to find a new, stable future funding solution. My preference would be to have a compulsory, a universal system, and that will create a framework around which we can provide solutions and advice to our customers. Thank you for your time. I'll be interested in your comments and your questions. Thank you.